Most people approach retirement backwards. They work for 40 years, save whatever they can, and then cross their fingers and hope the numbers somehow work. No real structure, no deliberate asset plan, no clear separation between what is supposed to produce income, what is supposed to grow, and what is supposed to protect them when life turns against them. Hope is not a strategy. By the time you are 65 and realize the math does not work, you do not get a second shot at compounding. You do not get back the 20 or 30 years when a few sensible decisions could have changed everything. Time is the great advantage in investing, and retirement planning is one of the last places where people seem willing to ignore that fact. So let me be very plain. If I were building a retirement plan from scratch, there are 5 asset categories I would insist on owning before I stopped working. Not because they sound sophisticated, not because Wall Street can package them into something expensive and confusing, but because they each solve a real problem that shows up in retirement. You need income, you need growth, you need inflation protection, you need stability, and you need low fixed expenses. When those pieces are missing, retirement becomes fragile very quickly. The first asset I would want is a diversified portfolio of high-quality dividend growth stocks. When people retire, they usually discover something uncomfortable. A portfolio is not the same thing as income. A statement balance might look impressive, but unless those assets are producing cash, you are left with only one option. You start selling pieces of your future to pay for the present. That is a dangerous way to live. If the market is rising, people convince themselves it is fine. Then the market falls 20 or 30%, and suddenly every withdrawal hurts twice as much. You are not just spending money. You are liquidating assets at depressed prices. A bad sequence early in retirement can do more damage than most people appreciate. That is why I have always preferred cash flow from productive assets. With the right dividend growth companies, you can own the business, collect the income, and avoid selling shares just to keep the lights on. The ideal business is not glamorous. It is durable. It earns real money. It has pricing power. It has a balance sheet that can survive bad environments, and it has a long habit of sending more cash to shareholders year after year. That last part matters. I am not talking about chasing the highest yield you can find. A high yield by itself can be a warning sign. Sometimes it means the business is deteriorating and the market already knows it. I am talking about companies that have increased dividends for decades because the underlying earnings keep rising over time. Think about what that means for a retiree. You do not just need income in year 1. You need income in year 10, year 20, maybe year 30. If your income stream is fixed while your grocery bill, insurance costs, medical bills, and property taxes rise, you are losing ground every year, even if your portfolio statement looks stable. Dividend growth solves that better than most retirees realize. Suppose you retire with $1 million and a portfolio of dividend growth stocks yielding 3%. On day 1, that gives you $30,000 a year. Many people look at that and say it is not enough, but they stop the analysis too early. If those dividends grow at 6 or 7% a year, the income picture changes dramatically over time. 5 years later, the income is meaningfully higher. 10 years later, it is on a completely different level. 20 years later, the difference is enormous, and the whole time, you did not have to sell the machine to get the cash. That is the point. For retirement, I want boring excellence. I want companies that sell products people keep buying in recessions and inflation, in calm periods, and in messy periods. I want strong brands, stable demand, disciplined capital allocation, and management teams that treat the dividend like a promise, not a suggestion. That portfolio becomes your income engine. The second asset I would want is a low-cost S&P 500 index fund that I do not touch unless I truly have to. A lot of people hear that and say, if I already have dividend stocks, why do I need an index fund too? Because retirement has 2 jobs, not 1. It has to pay you now, and it has to protect you later. Dividend growth stocks can do a lot of the work on the income side, but you still need a separate pool of capital that can keep compounding quietly in the background. Inflation does not stop just because you retired. Medical costs do not stop. Longevity risk does not stop. The possibility that you live much longer than expected is not a problem. It is a blessing. But financially, you need to plan for it. That is where an index fund matters. When you own a low-cost S&P 500 fund, you own a broad slice of American business without pretending you can outguess all the moving parts. You are not trying to identify the one magical stock. You are buying the productive center of the economy. Some businesses will stumble, some will disappear, others will rise and replace them. Over long stretches of time, that simple structure has done far better than most people imagine, provided they leave it alone. That last phrase is important, leave it alone. The index fund is not there for you to poke and prod every time the news gets ugly. It is not there for you to sell, because some commentator says the world is ending. It is there because over long periods, productive businesses keep earning, adapting, surviving, and growing. So I would treat it differently from the dividend portfolio. The dividend portfolio is what helps pay the bills. The index fund is the reservoir. You do not drain the reservoir because you had one dry month. You protect it, you let it compound, you touch it only for true emergencies or extraordinary needs. A retirement plan with no growth engine slowly becomes a race against inflation. A retirement plan with only a growth engine and no income becomes a stress test. I want both. The third asset I would want is income-producing real estate, or if direct ownership is not practical, REITs. Now let me make an important distinction. Your primary residence is not an income asset. It may be a wonderful life asset. It may be emotionally important. It may even appreciate in value. But unless it is producing cash, it is not helping fund retirement. In fact, it is usually consuming cash through taxes, insurance, maintenance, repairs, and all the quiet costs that come with ownership. What I care about for retirement is real estate that sends money back to you. Rental property can do that. REITs can do that. The reason I like this category is simple. It adds a different kind of cash flow. Stock dividends come from corporate profits. Rental income comes from people paying for a place to live or operate. Those are not identical streams. And that matters. Retirement is easier when your income is not dependent on one single source. There's another benefit. Real estate has a habit of adjusting to inflation in a way retirees find very useful. When the dollar weakens and the cost of living rises, rents often move higher as well. Not perfectly and not instantly, but over time the asset has a built-in relationship with the real economy. That gives you a hedge that pure paper assets do not always provide. If you own a solid rental property with sensible leverage, or better yet, no leverage at all by retirement, you have an asset that can keep sending you checks while the underlying property also holds value in a world where everything costs more. If being a landlord sounds miserable to you, that is fine. Not everyone should deal with tenants, repairs, vacancies, and management headaches. That is exactly why REITs exist. They allow you to own portfolios of income-producing properties without personally replacing water heaters or chasing late rent. The point is not the form. The point is the function. I want a retirement portfolio that has cash flow from business profits and cash flow from real assets. That combination is stronger than either one alone. The fourth asset I would want is inflation-protected government securities, especially TIPS or I-bonds. Retirees underestimate inflation because it often feels gradual right up until it does not. A lot of people think of inflation as an annoyance. A little more for groceries, a little more for gas, a little more for travel. But retirement turns inflation from an annoyance into a structural threat. If you are living on fixed income and your expenses rise every year while your income does not, your standard of living quietly erodes. That is how people become poorer without realizing it at first. Traditional bonds do not solve that problem very well when inflation is persistent. They can actually make it worse. You receive your interest, but the purchasing power of that money keeps shrinking. On paper, everything looks fine. In reality, you are going backward. TIPS and I-bonds exist for one reason. They are designed to adjust with inflation. That does not make them exciting. It makes them useful. I do not want this category to be the whole retirement plan. It is too defensive for that. Over long periods, productive businesses and income real estate should do much more of the heavy lifting, but I absolutely want some portion of the portfolio dedicated to protecting against the possibility that inflation turns out to be nastier and more persistent than expected. Think of it this way. Dividend stocks and real estate are offense. Inflation-protected securities are defense. Good retirement plans need both, not because you know exactly which risk will show up next, but because you do not. The fifth asset I would want before retirement is not something Wall Street likes to call an asset, but it changes the equation more than almost anything else. I want a paid-off home, or at the very least very low housing costs. This matters enormously because retirement does not fail only from bad investments. It also fails from bad expense structures. Housing is usually the biggest line item in a retiree's life. If you go into retirement still carrying a heavy mortgage payment, you have created a permanent drain on your cash flow before the market even gets a vote. That means your portfolio has to produce more income every year just to keep you stationary. It means every downturn feels more dangerous. It means every unexpected expense bites harder. Remove that mortgage and the entire system becomes easier. Your required income drops. Your flexibility rises, your stress level goes down, your ability to survive rough stretches improves immediately. Now, I know there are people who will say the math sometimes favors keeping a low-interest mortgage and investing the difference, and in a narrow spreadsheet sense, that can be true. But retirement is not a spreadsheet contest. It is a life design problem. There is enormous value in knowing the roof over your head is yours, your baseline housing cost is manageable, and no monthly mortgage check is competing with groceries, travel, family help, or medical expenses. A paid-off home does not make you rich. It makes retirement less fragile. That is more important. Now, when you put these 5 assets together, you get something most retirees do not have. You get structure. You are no longer depending on one fragile assumption. You are not saying, I hope the market always goes up. You are not saying, I hope inflation stays low forever. You are not saying, I hope I die before the money does. You have an actual system. Dividend growth stocks give you current and rising income. The index fund gives you long-term growth income, real estate, or REITs. Add another cash stream and inflation sensitivity. TIPS or I bonds give you explicit inflation defense. A paid-off home keeps the largest expense under control. That is how retirement stops being a guessing game. But owning the right assets is only half the battle. People still sabotage themselves with avoidable mistakes. The first common mistake is putting too much money into bonds just because they sound conservative. A lot of retirees hear the word safety and rush into fixed income. What they forget is that retirement can easily last 25 or 30 years. A portfolio that does not grow enough is not safe. It is brittle. Bonds can serve a role, especially inflation-protected ones, but a retirement plan overloaded with low-growth assets slowly gets cornered by rising costs. The second mistake is retiring without enough income-producing assets. This happens all the time. People build a portfolio of growth stocks, watch the balance rise for years, and assume they are prepared. Then retirement begins, and suddenly every dollar of spending requires them to sell something. They built a pile of assets, but not a paycheck replacement. That is a structural flaw. The third mistake is carrying a mortgage into retirement. I have already said it, but it deserves repeating because it is one of the cleanest ways to make retirement unnecessarily difficult. High fixed housing costs turn ordinary market fluctuations into emotional emergencies. The fourth mistake is lack of diversification. Some people go all in on the market, some go all in on property. Some go all in on safety. Every one of those extremes creates vulnerability. Different assets respond differently to different environments. That is not a theory. It is how the real world works. The fifth mistake is starting too late. This one is brutal because time is the one ingredient you cannot buy back. Dividends need time to grow. Index funds need time to compound. Mortgages need time to disappear. Real estate needs time for rents and equity to build. You cannot compress 30 years of compounding into the last 5 years before retirement. Arithmetic will not allow it. So what should the roadmap look like if you are in your 30s? Your advantage is time. I would focus heavily on the index fund and start building the habit of owning quality dividend growers. You do not need everything at once. You need the process started if you are in your 40s. I would still be building those 2 categories aggressively, but I would also start seriously thinking about income real estate and a deliberate plan to get the mortgage under control. If you are in your 50s, this becomes more urgent. You want the 5 pieces taking shape. Not theoretical, not something you plan to look into next year. Real, visible progress. The portfolio should be getting simpler and stronger, not more experimental. If you are in your 60s and these pieces are not in place, then clarity matters more than comfort. You may need to work longer. You may need to downsize. You may need to reallocate aggressively away from complexity and towards structure. None of that is pleasant to hear, but reality does not improve because we avoid looking at it. What I can tell you is this: retirement does not reward last-minute panic. It rewards long periods of steady, rational action. That is how good retirements are built. Not by finding one magical investment, not by predicting the market, not by hoping Social Security covers everything, not by convincing yourself you will somehow figure it out later. Good retirements are built by owning the right assets early enough and keeping them long enough. I have watched people with ordinary incomes retire well because they built sensible systems, and I have watched people with high incomes retire badly because they never gave the problem real structure. The difference was not brilliance, it was preparation. So here is the challenge. Do not read this and simply agree with it in the abstract. Pick one action, buy your first dividend growth stock or your first broad index fund. Research REITs or income property seriously instead of casually. Purchase your first TIPS or I-bond position. Make an extra mortgage payment. Consolidate the part of your plan that is still vague, one action, then another, then another. That is how retirement confidence gets built, not in one dramatic move, but in repeated rational steps taken early and taken consistently. If you do that, retirement becomes something very different from what most people fear. It becomes stable. It becomes manageable. It becomes flexible. It becomes a phase of life where your assets are working for you instead of forcing you into constant worry. And that, in the end, is what you should be aiming for. Not some fantasy of unlimited luxury, not financial theatrics. Just dignity, independence, rising income, controlled expenses, and enough growth to protect your future. That is what these 5 assets can give you. Build them before you retire, because once retirement arrives, the verdict is already close to written, and the people who enjoy it most are rarely the ones who guessed right at the last minute. They are the ones who prepared.